right, this is Taking Stock on Bloomberg. European finance ministers, they're going to meet in Luxembourg beginning on Sunday to try to work out a rescue plan for Greece. There was some movement today as Germany and France appear to have resolved their differences on whether private bondholders should be forced to shoulder a share of the rescue plan. Well, let's ask my next guest about the effects of all of this on the markets. We have Dennis Hynes, Chief Market Strategist, R.W. Pressprich. He is the former director, Morgan Stanley, and also a black belt in karate, right? You maybe need those karate skills now in the market.
If I was in this market, yes, I probably would.
Now, you say if you were in this market. That sounds like if you were my accountant. Well, you're not in the market.
That's correct. I'm out of the market. I've been out of the market. I'm in cash. I've been in cash since the end of May. Now what's happening is the question is, should I go short the market? That's the real question.
You make a lot of money if you get a good call on going short, right?
Yes, you do. But
you get those big market reactions, those big emotional moves.
You get steep declines with rapid short covering. So it's a very dangerous market. You really need to know what you're doing. You really need to be able to sell rallies, which most people can't do.
It's emotionally difficult. It's psychologically painful to do that, right?
Yes.
Tell me about Greece and what's going on right now.
Well,
do you really think that Angela Merkel and the Germans agreed with Nicolas Sarkozy of France and said, okay, we're not going to make the private bondholders take a haircut on any of the debt?
It's prudence versus profligacy. The Germans are very prudent, and it can be very cool. They're very cool people. They do a great job with their cars and everything else. But there's not possible that they can get the bondholders to create a credit event. Credit event would cause the entire thing to dismantle. You know, people are not worried about Greece. I mean, they can handle Greece. It's the ones that follow behind it, the domino effect. Ireland, really not that much of a problem, probably, or Portugal. But the real concern here is getting to Spain, because once you get to Spain, all bets are off.
Well,
now America's in the game.
We even had the story today, Bloomberg reporting from Moody's, that they were putting Italy's debt on credit watch.
That's right. As long as you don't create a credit event, then you have no problem. All you need to do is just keep paying, keep bailing people out, keep kicking the can down the road.
But where does the money come from? The taxpayers of Europe?
It comes from nowhere. It's a bookkeeping entry. It's like what we do in our country. We make money out of nothing, out of thin air. We hope to pay it back when things improve. But right now, the most important thing is to push it back and to make sure that we don't have to deal with the reality. This is like musical chairs. You don't, when the music stops, you better be able to gain a chair. Otherwise, you're out of business.
Well, let's use that metaphor just a little bit longer. If that music stops, what about all the banks that are holding the bonds and have used this stuff as collateral for other types of investments? I mean, haven't they had enough time to get out of this position?
No, not really. It's similar to what happened, if I can use the analogy, with Bear Stearns, Lehman Brothers. We had Bear Stearns was bailed out. There was an uproar about bailing out big financial companies. Then we followed, and the Treasury got very strong with the Fed, and they stopped Lehman Brothers. And everyone was applauding the courageous act on the part of policymakers. Right behind that, of course, was this incredible surprise called AIG, which, in fact, all of a sudden, the Fed had to come back and the Treasury had to come back and say, I'm sorry, we have to bail these people out. I'm afraid that's the same concern that the ECB is faced with and the IMF is faced with, because you don't know what's behind that green door. And once you do, okay, then you can deal with it. But right now, what you're simply trying to do is buy time. And you're using bookkeeping entries. That's all this is.
But isn't it a little bit different when you talk about the European Central Bank? Because what power does it have over the sovereign nations of Europe? I mean, at least in the United States, the Federal Reserve is the Federal Reserve for all of the United States.
That's their problem, by the way. Their problem is they're concerned about losing authority, which is another reason why they're asking or doing everything they can to not create a credit event. Because the sovereign 17 units here, they need to make sure that they do, in fact, control what's going on. And they know that should they allow a credit default to occur, then the sovereign risk would come right to the forefront.
Now, as we started this segment, you said you've been in cash since the end of May.
Yes.
And now you're trying to determine whether to actually go short. You don't sound like you got a lot of optimism about the market.
Well, the market is a bit of a mixed bag right now, with the S&P, which of course is the large companies, if you will. What's happened is that we've come down after this brinksmanship act on the part of Germany and Greece. What's happened is the market has come down to its 200-day moving average on the S&P, and it has found buyers. So what that does mean is that at least with the S&P, there is a chance that the market may catch somewhat of a bounce here. Now, on the other side, if you look to the technology sector has done just the opposite. We have the NASDAQ composite breaking its respective 200-day moving average, which is suggesting stay away from technology. At the very least, the S&P, be defensive. If you need to be in the market, be defensive, and that means defensive sectors. That, of course, is utilities, healthcare, and staples.
We got to leave it there. I want to thank you very much. Dennis Hynes, RW Pressprich, appreciate your insights as always.